Imagine a time when your money, held securely in a bank, could suddenly disappear overnight. Picture widespread panic, bank doors closing forever, and the complete collapse of financial trust across an entire nation. This terrifying scenario became a stark reality for millions during the Great Depression. To combat this unprecedented crisis, the United States government launched a series of bold and comprehensive actions, notably implementing the bank holiday, enacting the Glass-Steagall Act, and establishing the Federal Deposit Insurance Corporation. These measures fundamentally reshaped the American banking landscape. The core problem during the Depression bank failures was a devastating loss of public confidence, leading to mass withdrawals known as bank runs. Without deposit insurance, people feared losing their life savings, triggering a domino effect where even financially sound banks could be forced into insolvency by sheer panic. The government understood that restoring trust was paramount. The bank holiday provided an immediate, temporary halt to all banking operations, allowing time for federal review and for the panic to subside. This pause enabled regulators to separate solvent banks from insolvent ones. Crucially, the Glass-Steagall Act addressed the underlying structural weaknesses by legally separating commercial banking, which takes deposits, from investment banking, which deals in securities and more speculative activities. This separation aimed to prevent risky investment practices from endangering depositors' funds. Finally, the creation of the Federal Deposit Insurance Corporation directly tackled the confidence crisis by guaranteeing a portion of individual deposits, assuring citizens that their money was safe, regardless of what happened to their bank. During the bank holiday in March 1933, President Franklin Delano Roosevelt temporarily closed every bank in the nation for days. Only banks deemed sound by federal examiners were permitted to reopen, giving the public a clear signal of their reliability. The Glass-Steagall Act mandated this functional separation through specific legislative measures, forcing banks to choose between commercial or investment banking roles. The Federal Deposit Insurance Corporation began insuring individual accounts up to $2,500, a substantial sum back then, effectively eliminating the fear of losing savings due to bank failure. Prior to these interventions, the banking sector operated with minimal federal oversight, a stark contrast to the modern regulatory environment. These Depression-era reforms introduced the concept of a financial safety net, fundamentally altering the relationship between citizens, banks, and the government. They highlighted the interconnectedness of the financial system and the profound impact of collective confidence, introducing systemic safeguards designed to prevent a recurrence of such widespread failure. The decisive actions taken by the government during the Great Depression were not merely reactive, they were transformative. They not only provided an immediate antidote to a collapsing financial system, but also established enduring regulatory pillars that continue to underpin the stability and public trust essential for a healthy economy today. These lessons remain highly relevant for understanding financial regulation worldwide.